Welcome. My name is Sasha Moore and I'm delighted to welcome you today to the Grow Finance panel event. In this session, we'll be having some robust discussions about the current commercial finance landscape, the corresponding pressure points, get a bit of an indication of what the panel's thoughts of the next 6 to 12 months might look like, and also what the corresponding opportunities are for brokers. This will be reviewed from the lens of an economic, lender, broker, and risk perspective to give the full multi-dimensional viewpoint of how, where we are and how it looks like moving forward. So without further ado, let me introduce you to our esteemed panel. We have Scott Mason here from Equifax, who is the GM of Commercial and Property Solutions, who's going to really talk to us from that macroeconomic perspective. Welcome, Scott.
Thank you.
We have David Verschoor, who's the co-CEO of Grow Finance, here today to talk really from a lender perspective in the non-bank sector. We have Max McFarlane here, who is going to give us the perspective from an on-the-ground broker's point of view. And then we also have Vlad Gilidov, who is the Chief Risk Officer at Grow Finance, who will be giving that lens of what it looks like behind the scenes of this radical and changing and evolving place that we're in right now. So without further ado, let's kick off. Scott, I'm going to put you into the hot seat. So what I want to do is really unpack the current commercial finance landscape, and we're going to start with the great research from Equifax and the quarterly report that Equifax has put together, which is really stimulated this panel event and the relative content that we're talking to. So Scott, the recent Equifax research indicates that business loans were the strongest performer in 2021, and up 2% compared to, I beg your pardon, up 2% and up 19% compared to 2020. So I'm interested from your perspective, this growth in business loans, where do you see the driving factors for that?
Well, I think if you look at, so the report that we do always looks at a quarter two versus quarter two of the previous year, but we also include another year because of the COVID situation.
Right.
So if we talk specifically about business loans, throughout COVID, right back from where our index starts in December 2018, we've seen a continued growth in strong performance in business loans, as opposed to the other inquiry types of trade finance and asset finance. So it's interesting because I think a couple of things. One is capital is available. So there's not a shortage of money. And when I speak to the leaders of the business banks and the Big Four, for example, they're all madly trying to still acquire new customers. So there's strong demand in the economy, as well as there's capital available. So I think that's why we continue to see strong performance of business loans.
Okay, and in terms of the strong capital demand, what's your view of the debt structures at the moment and availability of capital?
Well, it's interesting. During that, obviously it varies from sector to sector, but I think that what we did see, particularly in, like if I look at the trade finance area, for example, what we did see during COVID is people used a lot of the money that came through government stimulus to pay down debt. So if I talk to some of the risk officers in some of our large trade credit providers, what they all said was quite surprisingly that they never had better days beyond terms, for example. So people were paying down debt and taking care of their credit. Obviously, that's not 100% of the case, but generally that was the trend. So I think the debt situation was that a lot of companies came out of COVID from a debt point of view in a relatively strong position.
Okay. So I guess if we move forward in terms of, David, I'm going to direct this question to you. At this time, the Big Four lenders reduced by 4.4% in market and international lenders increased by 37%. From a lender's perspective, what have you noticed, and in particular how that's affected the non-bank sector?
I think for non-banks, what we've seen an influx of foreign banks into providing warehouse facilities for non-banks. That's obviously seen their share of the total grow, and with that came, those strong borrowing conditions and availability of cash via those lenders. So, Grow Finance was one of those, but we've seen very strong growth from internationals providing liquidity to our market.
And in terms of your thoughts of where that's been versus how that's now moving?
Clearly with interest rates rising, and we've seen money being pulled out of the sector, particularly in the funds management areas. And so what we're seeing is cost of those warehousing facilities and non-banks' capability to borrow money is going up. And with that, we're seeing a bit of a shift back off to the traditional big four lenders, particularly in mortgages where they are, pretty good at what they do there.
So I think that raises an interesting point, because my observation was, there was a flight to non-banks, particularly over the pandemic, but perhaps that's now swinging back to the more institutional lenders. Are you finding that as much or not at all? Not so much?
Well, we're definitely seeing now a shift in the last few months back off to, the institutional big four banks. And so that's something that's going to be a trend that sort of continues into the rest of this year.
So, and one thing that I know that we were talking just offline before about previously was the buy now, pay later trend. So, how do you see that particular area of finance playing out?
So I think the BNPL, card providers in Australia have done an amazing job in growing out those segments in Australia. Primarily, it's driven by millennials buying goods and using, in a smart way, to use the product as a way, instead of a credit card, as a way to buy those things. And what we've probably seen is a bit of saturation in those segments. I think they will still be around for a long time, but we have seen a little bit of a shift back to traditional credit cards as well. And as people need to buy things and use that in their businesses, and so that's something that we're looking into as well on our side.
Okay. And Vlad, I'll go to you because with all of the volatility, I expect that from a credit and a risk perspective, that's posed some challenges. So what have you noticed from a risk perspective, particularly if we sort of go back to more the business loan side of things and the growth of business loans? What are some of the trends that you've noticed, or what are some of the policies you've implemented?
So look, we'll look at business loans as a quick and cost-effective way of accessing cash for SMEs. And it's a good alternative, specifically to the non-bank sector, to access capital. What we're seeing is, the first thing to say, I don't think we're seeing anything alarming from our point of view. Most of the businesses seeking funding is actually to grow, which is quite positive. And it's the typical purposes are, I need to hire people, I need to buy additional stock. So the purpose is always positive, the purpose is always to expand. So from our point of view, we remain quite open-minded and quite bullish on the sector. The quality of the business that we're seeing is really good. And if we can continue monitor this closely, and specifically, we'll talk a bit later around specific sectors in the economy that potentially cause some concern, but the demand from what we're seeing is pretty strong, and in the short term we expect it to remain pretty strong despite the increase in interest rates. We have not seen a slowdown at all.
And just to add to that, we're seeing like trends of arrears on our platform that are to much lower arrears, and this is something that speaking to our peer lenders as well, the trend of lower arrears through their own lending is actually quite a strong trend. So what that means is that despite recent interest rate hikes, we're actually seeing these companies come out of the COVID period stronger, and their cash flow is accelerating more than anything else.
Yeah, and I think it's an important point. Over the last couple of years, a lot of businesses use government stimulus to pay back more expensive debt, and potentially that's why the banks remained in a bigger way in the non-bank sector, because some of the more expensive debt potentially has been paid off. Now that they've come out of COVID and they're seeking to expand and grow, the non-bank sector is much more relevant than it was potentially a couple of years ago. So.
Well, I think, in terms of that swing to the non-bank sector and business loans being very much aligned with that sector, what would you predominantly look at the reasons why for that? Is it to do with, the lending criteria being more flexible, or?
Potentially. I'd say that the non-bank sector is probably a little bit more open-minded. Probably takes a little bit more time to understand the client, and that's more to do so, to have a conversation with the customer, to understand their needs and potentially put a solution together that solves their specific need. And look, as I said, most of the requests that we're getting are actually to expand the business, and that's just exactly what we're here for, right? Our aim is to support the growth of the businesses.
Which I guess is also a bit of a contrast, because a lot of people associate the pandemic or the turbulence with distress. But what I found interesting from the Equifax data is it's sort of to the contrary, and listening to the usage of funds, it is to the contrary. So I think that growth story is really quite powerful and representative of market, as much as obviously distress is a factor. Max, what about you? How have you found the demand for funding, and what are your thoughts about the business loan sector?
From a broker perspective, the rise in that sort of non-bank business loan space has exploded over the last few years. A lot more liquidity behind the scenes coming into the market, and there's more options available to brokers than ever before to be able to sort of provide that to various SMEs, which is great because a lot of businesses relied on that. They may needed it faster, more flexible. It was a better cost of capital for them available. So it's a growing space. I think it will continue to grow, and it's an important part for brokers to be able to offer their clients.
And what have you found, say, over the last 12 months compared to now, is the main requirements for business funding?
It's usually a bit of a balancing act between cost, security and speed.
Right.
Around that. I think there is still a lot of businesses growing, trying to cover staff costs, material input costs, and to grow. And there are some also trying to just sort of save costs as well through financing to be able to do that. So generally, I think businesses are still going quite well, and still sort of operating quite strongly. And I think for the most part, the demand will keep up in the short term.
So in terms of what that looks like at the moment, so what are you seeing as the primary avenues for business funding? Like what is it? What are clients coming to you for?
Sure. Across different product classes, so we talked about business loans, there's also asset finance, invoice and trade finance as well. All of them are essential for SMEs and mid-market businesses to be able to sort of get that capital. So there's the business side for term debt, sort of functioning in that space. Asset finance is still a big piece. Clients are still trying to buy equipment, still trying to grow through getting those assets, anything wheels and a serial number to grow. And trade and working capital for the invoice side is also a growing segment as well.
And Scott, I don't know where you are in your next research process, but are you expecting, just based on the growth and demand of the business loan sector, to continue?
Yeah, I mean, I think at the moment the answer to that would be yes. I think that it'll be very interesting 6 months actually to see what happens. Obviously, consumer confidence and interest rate rise may have an impact eventually when that washes through, but based on the data that we're still seeing continuation of those trends. So we're still seeing, trade credit, I think, is getting stronger. Business loans are still strong. Asset finance has always been a bit up and down for various reasons that we can talk about. But at the moment, there's no reason to expect, based on what my conversations, what we've heard this morning, that that's going to change in the short term.
And do you see a correlation between consumer confidence and business confidence?
It's not something. Well, so yes, we do. Obviously, a lot of the work that we do is we focus on the directors, so they're consumers that sit behind the business. So we've done some work on the relationship between proprietors, personal loans and mortgages, and what. And how likely they are to be in arrears compared to the average population. And we do see some early signs of some stress in that area around mortgage and personal loan uptick in arrears for directors and SME proprietors. So there's a definite relationship there. And there are some early warning signs that there may be some stress there, but we'll continue monitoring that over time.
Okay, sounds good. Well, staying with you, Scott, contrary to what we may have expected, the Equifax reports indicates that asset finance demand has been reduced by 9% year on year. I was just hoping you could talk through that.
Yeah, asset finance is an interesting one, right? Because it's always cyclical, right? So Q2, as people enter the financial year, we often see an uplift in capital spending. And that trend has continued. Where the negative 9% is comparing Q2 this year to Q2 previous year. And I think there's two factors to that. One is well-documented supply chain shortages. So obviously people may be struggling to spend that capital because the stock or the capital equipment's not available. But I think the thing we've got to keep in consideration is that the government stimulus packages where you're allowed to have instant capital write-off, what that meant was people often brought forward those capital purchases. So once you've bought, a fleet of Hiluxes or whatever, 1 year, you don't replace that every single year. So I think some of that is sort of overstating the downside, if you like. So I think that a lot of capital purchases during that period of time, because of the government benefit, actually encouraged companies to bring forward those purchases.
Right, okay. And David, what's been your observation with that? Because I know that from Grow's perspective, asset finance has been booming, which is why but I understand sort of within that relative context. So what have you found?
I think mainly what we've seen is second-hand equipment really being in huge demand. And obviously with those supply chain issues that you've just mentioned, obviously getting those new equipment into the country has been a problem, and some of that's been driven by chip shortages and the like, but actually getting that equipment into the country has been quite an issue. What we have seen is a number of our customers using trade products to buy second-hand equipment out of the UK or the US, importing it, and actually might be cat gear or the like, but and then entering into a finance agreement afterwards on the asset finance side. So we're seeing quite a bit of that. As I mentioned, we're seeing quite a bit of on the asset finance side again, second-hand equipment, and what we have seen is elevated levels in terms of prices on second-hand equipment. So that's pushed things as well. But as we see supply chain sort of easing up a bit here, we'll get China reopening. I think these are things that are going to be a thing of the past, and we'll probably see a bit more growth through that segment as that supply chain eases.
Right. And Max, what about you? What demands have you what changes in asset finance demands have you seen, and what do you expect that's now going to be looking like?
I'd probably build on what's already been said. I think the instant asset write-off scheme really did change a lot of behaviour around businesses buying earlier than they might have to try and get that incentive and write-off. So I think that definitely happened. I think also a lot of businesses actually had a lot of cash after the pandemic from business loans, and if it wasn't used for operations or dividends, it was also used for assets as well. So a lot of activity was already bought up. And I also think I get a sense that businesses are sort of holding their breath, a bit of a wait and see before sort of large capex spending. So asset finance might sort of, the demand might pick up as supply chains improve, but prices in the second-hand market are still really elevated.
Yes.
But there's still demand there, because if a business needs an asset, they're going to buy it.
Right. And one thing that I was just wondering, and I might direct this back to you, Scott, do you expect that it's cyclical? Do you find that businesses, particularly say with vehicles or so forth, it is more of a cyclical environment where, if they are buying advanced purchases now, will that, do you think, have any ripple effect moving forward? Or, once the end of lease or end of term comes through, like what has been your observations?
Well, I mean, I think what you will find is that there was a couple of years of slightly unusual behaviour, and supply chain also, as the others have said, as that frees up. I would imagine asset finance is still cyclical.
Yep.
I think we'll get back to a much more natural sort of pattern in the next year or two. As I said, as people get back to a normal sort of purchasing rhythm and supply chain eases up, we'll get back to a more normal pattern. Right.
And what have your observations been, Vlad?
Look, I think because we're quite open to second-hand equipment, we haven't seen a downward trend at all in demand. If anything, it's quite the opposite. I think the main issue is availability of brand new equipment. It's been pretty hard, and you speak to a lot of business owners, and the response is the same. I need this now. I can't get this into the country, be it a truck or some sort of fabrication machine. So they go and look for a second-hand option locally, or they bring one from overseas, which has been a good for Grow because we're able to help them with the import piece and then put an asset finance once the machine lands in Australia. On the second-hand front, it's been pretty busy for us, and I don't see that slowing down anytime soon. The rates have gone up over the last 2 to 3 months. That hasn't had much of an impact at all on demand, and the quality of the credit remains pretty sound, which is very encouraging for us.
Okay, interesting. Well, we might move on to trade credit. So the Equifax report indicates that while there's been a nominal dip of 2% to 2021, demand is significantly better than the levels observed in Q2 in 2020. So David, I know from Grow's perspective, there's been quite a notable increase for trade finance and invoice finance for that matter. Can you give some insights into, I know we sort of touched on it briefly as it related to the assets, but in particular, if we just look at trade to start with?
Yeah, so I think input prices have risen, no question about that. We've seen cost of building products rising, things like copper. We've seen copper prices go up quite dramatically. And so what we see out of that is demand for trade or trade finance products have gone up so dramatically. Part of it is just the volume need. And then the second part is before you might have had a business that was happily supporting, an import bill of $250,000, and suddenly now the cost of that's gone up to $350,000. So they're short of the $100,000 that they need to make that import happen. And so that's what's driving that demand through us at the moment.
And what have you observed, Max, in terms of changes of business buying patterns, particularly in that trade space?
The trade piece is really interesting because it mostly comes down to I think the cash flow gap that businesses will experience. If they're buying, whether it's domestic or international suppliers, they still need to sort of buy it to get it onshore, and those costs are going up. So they've got to fund that cash flow and working capital cycle in some way. And I think that debtor days and credit days, it has been widening. So they're looking for solutions to cover that cash flow gap to do it. So I think it's a growing area around that, and particularly for businesses that are trying to import more from overseas.
And Vlad, I guess from your perspective, this is a growth area of finance. What are your views of that from more of that credit perspective?
I think the only thing worth mentioning from my point of view that hasn't been mentioned before is we've seen a lot more equipment being imported, which is going back to sort of to 2020. We probably didn't have a lot of that, where a lot of the stuff was purely inventory coming into the country. Now it's not unusual for us to receive requests to bring a piece of machinery and even second-hand machinery from US, UK or somewhere else, Asia, because there's such a shortage of equipment in Australia. So for us it plays quite well because we're able to import the machine and also put on asset finance once it lands. I find the actual applications are now a little bit people are more opportunistic because they're trying to purchase as much as possible while they can and bring it in Australia with a view of, okay, let it sit, wait in the warehouse for a little bit longer, but at least we've got the stock available. It's quite lumpy. That's what we're noticing as well, that the nature, each transaction is a bit different than the one before. But we expect that to continue, I think.
And Max, has that been your experience that there are larger purchases but lumpier purchases?
Yeah, some buyers might be opportunistic about trying to get supply discounts. Suppliers might be extending terms or the new suppliers, and so they'll want to maybe sort of pay up front to get that discount from trade finance and to be able to sort of do that. But it can be a little bit more cumbersome and administrative on the business and managing that as opposed to sort of just a more streamlined overdraft product or something as well. So I think partly it's around education for businesses to learn how to use that product to actually sort of maximise that working capital cycle.
Okay, well, we might move to invoice finance. So David, what have you found in terms of the relative demand for invoice finance in this current landscape?
I think as you see the businesses accelerate out of the COVID period, what we are seeing is people are building back up their credit facilities where they are providing credit to their suppliers, and as a result, we're seeing that invoice finance segment grow as well. And I think it's more from existing clients that we're seeing quite a decent growth factor on than new clients necessarily coming to us with asking for solutions. But we're definitely seeing those receivable books grow quite significantly, and with that, their need to use that to go and buy more on the supply side, and buy those goods, usually an import from China.
And what about you, Scott? How have you noticed invoice finance trends been?
Oh, look, I've got nothing more to add on that one, to be
Yeah.
totally honest. It's not something that we directly trace. So, yeah, I've got nothing really to add.
No. Well, that's easy then. So how about you, Max? Because I know that with invoice finance, it's a really dominant type of finance overseas, but it seems to be gaining momentum in Australia. Have you found a greater acceptance, or is this still a relatively new area of finance for a lot of businesses to consider?
Unfortunately, in some historical ways, some businesses might have a bad perception of that as a product, but I think that's definitely changing. And there's more lenders and competition in that marketplace. I find when customers are going to get invoiced, it's sort of one or two reasons. One, it's to grow and actually just sort of meet demand for their services or products that they're doing. The other is to actually sort of maybe try and make ends meet. So it can sort of be either a product just to sort of get by or a product to grow as well. But it is a really important piece of how businesses can fund operations and growth. There's limits to how much property you can use and equity available in that, particularly as property prices might change. There's sort of limits there. There's unsecured term debt. So invoice is really that piece where you can scale it up and down and use it as needed. So I think it's an increasingly important part for brokers to be able to talk to their customers about, and it's good to see a lot more products in the market that can meet that demand.
And how about you, Vlad? What have been your observations of the demand or the cycles for invoice finance?
Probably a couple of things. What we're seeing is the utilisation or the usage by our existing clients has gone up. So we're getting probably more requests for increases than we were 12 months ago, which is indicative of what's happening in the economy, I suspect. And the other thing, because we're able to say our credit team looks across, it's the same credit team that underwrites all different products. So what we're picking up now is a lot more, for example, transport businesses that have strong tier 1 contracts, but they're struggling to keep up with the cash flow because they don't have a working capital solution. So we're seeing more and more in cross referrals that the credit team is able to send across to the invoice finance division, where they're decent equipment finance businesses that haven't got that solution, and the brokers, probably some brokers might not be aware of the product, or maybe to your point, it's not the product that's being sold widely. So what we're seeing is we're getting a little bit more traction by internally referring them into our sales team and the invoice side to say, hang on a second, this could be a solution for both parties, where you've got a decent business that's dealing with tier 1 clients and they're struggling to keep up with the expansion themselves, and we're able to potentially help out financing some of that working capital gap.
Okay. Well, I might move on to an interesting topic, insolvencies. So Scott, I'm going to direct this to you. You mentioned in our pre-panel recording discussions that the tsunami of insolvencies expected haven't occurred, which I was quite surprised at. And I thought it could be prudent to really sort of talk through the perception that there is a record number of insolvencies, or it perhaps feels that way, versus actual fact. So if you could maybe talk through that.
Yeah, sure. I mean, if you were to listen to a lot of the media reports over the last few months, there's been lots of noise about increasing insolvency levels, and they absolutely have increased. But I think if you look at the history, in Australia, typically we get around about 8,000 insolvencies per annum. During COVID, because of the government stimulus package and a whole series of other reasons, people not chasing debt, not doing court wind-ups, etc., we saw insolvency levels fall to record lows, down to around 4,000. They literally halved over that period of time. What we've seen this year is that we're starting to see, as the stimulus packages have been well and truly wound up, people are coming out of COVID, banks and creditors and the ATO, etc., all become more vigilant with actually chasing debt. What we've seen is that trend has come up. But if we were to, we're sort of halfway between normal levels and where we were in COVID. So if we were to flatten it off now, we would expect to do around about 6,000 insolvencies this year. Now, obviously, they may still trend up towards normal, so by the end of the year, we might be more at a normal level. But certainly, a couple of years ago, there was an expectation that when we come out of COVID, there would be a backlog of what was termed at the time zombie customers or companies
Right.
going under, and we'd see a huge uplift in insolvencies. And that, at the moment at least, hasn't occurred. We are seeing an upward trend, and in some industries such as construction and accommodation and food, we are seeing a slightly quicker return to normal, if you like. But that's sort of where we're at with insolvencies at the moment.
Okay, so would it be fair to say it's sort of course correcting to a more normalised environment?
I'd say we're trending up to a more normal level. Now, as I said, that might take 6 months or 12 months, but we certainly, at the moment anyway, haven't seen a flood of insolvencies that a lot of people, and to be honest, including myself, was expecting a year or two ago.
Good. Excellent. Well, we might move on to the macroeconomic pressure points now that we've dissected the current landscape, of which there are certainly a few. So the market's reopened. It corresponds with a 2-year hiatus, which you've aptly put has come to an end. So not unexpectedly, the ATO is pulling in the reins of being a quasi line of credit, and there is direct pressure on businesses to clean up debt. So Scott, let's start with you in terms of the tax pressures and what you've observed, and more importantly, how businesses can minimise their exposure now that the ATO is being more direct in their viewpoint about credit.
Yeah, I mean, I think what I can talk to is the fact that this year the ATO started to report customers who are in arrears with them to the credit bureaus such as ourselves. So what that effectively means, and you've got to be careful, because what the ATO are doing, if a small business owes over $100,000 in debt, has not contacted the ATO, has not responded to the ATO in 90 days, we're notified as a default or an arrears flag on our report that we get from the ATO. How we're handling that, and it's important, is the fact that, before I move that, the important thing is that once the company then engages with the ATO, we're required to expunge all record. So it's not like a normal default where we store it and it affects someone's credit rating indefinitely. So the way that we handle it is if that flag occurs, and it's a weekly feed, what we do is we adjust a credit rating. So a normal credit rating, for example, someone might have a company might have a credit rating of say 700. Any sort of flag from the ATO around that particular issue, we drop the credit rating automatically to 200. And what that means is that a company with 200 credit score would be a 50% likelihood of it being wound up in the next 12 months. However, if that company then engages with the ATO and we're notified of that, we have to remove that default. So basically, you could see in extreme cases a company floating on with a credit score of 700. We're notified by the ATO that there's a default or a potential default. What we do is we reduce the credit score to 200. In that week, they could engage with the ATO and we could be notified on the following fee, which means if you looked at their credit score, 1 week it's 700, next week it's 200, the following week it's 700. So, obviously the ATO are doing that to try and encourage people to engage with them, to get their debt under control. So there's definitely more pressure being put on the ATO, but that's how we reflect it as a credit bureau.
Which I think is actually really interesting, because that was definitely not my perception in terms of how credit was recorded. And I think that particularly for small businesses, if they are aware that they can engage with the ATO and that rating can be expunged, it would be a direct motivation to engage with the ATO and rectify that credit.
And that's certainly the intention.
Okay, fantastic. So Max, I know you've experienced quite a few clients who are under ATO stress as a result of the recent clawbacks. How is this really affecting the businesses that you're involved with?
The figure that comes to mind is that the ATO is owed about $34 billion, and they want to collect it, so they are putting pressure on to try and get that from the market. The issue from a customer's perspective is if they have a tax bill, it basically shuts the doors on cheaper sort of bank options for them, which means they're looking at sort of non-bank funding if they need it. A lot of businesses, put payment plans in place, which may have made sense from coming into COVID and sort of managing that, but they might need to wrap it up and sort of get that off, because it's not a good thing owing the taxman money. So it's always trying to sort of get that sort of resolved, and it does mean that they're going to be paying more for any financing requirement if they're growing, buying assets, whatever it might be. So often when dealing with clients that have that, it's about sort of getting rid of it and sort of making sure it's just cleaning the slate, so to speak. I do think the ATO is good. You hear Scott say that if they engage, it gets a bit easier. Because I do sort of find that sometimes the ATO can be a little bit heavy-handed in their approach to business doing 40 mil revenue to maybe a small mum and shop business, because it's kind of a one approach fits all, and they're not too sort of reactionary. So it is a key factor for the customers to sort of have that, but really just avoid the tax bill as much as possible.
Good advice. So, David, how have you found any demand in corresponding finance to address this issue?
I think we've seen people use the ATO as their piggy bank, so this is pretty much a pretty standard way that we've seen SMEs optimize their cash flow. But I think through this COVID period, we certainly have seen a lot of these businesses get their balance sheets under control. So we're not actually seeing the huge problems in the first place. But that being said, like I think it was Vlad was saying before, those companies that are borrowing money from a bank will be best placed to get financing from those banks or from a non-bank, more by understanding what they owe to the ATO and getting that under control, because we will be taking it into account when we lend these SMEs money.
And Vlad, how about you? What have you noticed in any?
We've been watching this for a couple of years, right? And we
Right.
kind of knew this was coming. And to be fair, business owners always use ATOs as a short-term funding solution, and I feel that's okay as long as it stays within control. And that's kind of the grey area. At what point does this become uncontrollable? So engagement and regular payments to the tax office is something we closely watch. So it's not so much how much you owe to the taxman, it's more how you've been behaving over the last 12 to 24 months. So people who typically make regular payments and either on plan or just voluntarily make regular weekly, monthly repayments, and there is a small balance owing, but you can see it's not out of control, it's well managed. We're okay with that, and most of our clients don't get worse than that. We started to see more applications where customers have fairly sizable outstanding debts and they've done nothing about it, and that's unfortunately not something we've been able to assist with, because we find that's a little bit alarming. So, look, most people in the market are paying their bills on time. That's what we're noticing, and the ones that are not, they're managing it well. And as long as they do that, we're quite open to helping them. And the opportunity for us is if they need to go to a bank or even refinance their home loan in certain instances. It's typically a request will come through, 150K to the tax office. I'm refinancing my commercial property. I need to clear this out. Can you please provide me with a business loan solution to fix that up? And we see that as an opportunity because the businesses are typically solid businesses. And again, that purpose, what's the purpose? The purpose is I need to buy another piece of real estate. So it's expansion and more adding assets to the balance sheet of the business. So we're happy to look at those scenarios. The key for us is it needs to be within control, it needs to be well managed, and the customer needs to be continually engaged with the tax office, specifically by making repayments, whether voluntarily or on arrangement.
Okay. Well, we've covered the pressure point that businesses are feeling with ATO debt, which is substantial. But I think, ultimately, I think what you were sort of suggesting as well, Scott, it is lending itself more to a stable business structure to not have as much debt and to clean things out and just be on top of operations and so forth. But in addition to ATO stress points, there's obviously a whole slew of different areas. So we've got inflation, we've got supply chain disruption, we've got rate rises, we've got the Ukraine war. So there are so many concurrent pressure points happening in market. Apart from the obvious pressure point with the tax in this pressure cooker that we're in right now. Max, I'll go to you. How are you finding businesses are affected by the concurrent pressure points which are occurring?
From COVID, it's really interesting to note that it was basically the greatest transfer of wealth from the government to the private sector that has occurred through a lot of the stimulus that went into the market. And so I think a really big concern is around consumer spending. One person's spending is another person's income, lower consumer spending, lower business income, right? And I do think that's a trend that is going to eventuate down the track. So that's sort of my bit more sort of pessimistic view. And so looking at that sort of consumer piece, I think the savings buffer is going to reduce. It will be eroded faster than people realise as rate increases going up. And so I think there is a tie between the consumer side and the business commercial industry that businesses are in. And so I think it is quite concerning to sort of see that partly there. On inflation, I think you sort of mentioned, look, I think the government says it's 6% or whatever it might be. An interesting idea, I think, is around like an individualised inflation rate. If you want to live in Bondi, drive a BMW, send your kids to private school, your inflation rate is going to be higher than if you drive a Mazda and live on the Central Coast and send your kids to public school. And that can also be applied to industries. Like if you look at the building industry, the staff costs and material inputs are much higher, and hospitality as well might be much higher compared to other industries as well. So I think inflation is a little bit, the headline figure is a little bit misleading, and I think there are sort of subsectors to that. And overall, the consumer spending piece is quite a concerning piece.
And Scott, I might go to you. What is your sort of general observation in terms of this holistic pressure cooker that we're in right now as to how that's affecting business trends?
Yeah, it's interesting because one thing I'd say is we're not economic forecasters.
Sure.
So we only can look at what the trends are saying. I think we've covered it this morning. At the moment, you would say businesses have come out with lower debt levels. There's capital available. Banks are still looking to acquire new commercial customers, and we haven't seen. Well, the comment has we've seen people still wanting to borrow to grow. Mm-hmm. So they're all positive signs. I mean, but I take Max's point is that there's a strong link in my mind. Two things. One is consumer confidence, and how increasing interest rates will continue to erode potentially that, and that will have a flow-on effect. And the other thing we haven't spoken about really is employment rate. So at the moment we've got a fantastic low unemployment rate, though it'd be interesting to see as things free up and we have an increase in immigration, maybe some other pressures. Will that change? Because I think while ever we have most people employed, I'm less pessimistic about the future, but it'd be interesting to see what impact that may have over the next 12 months, 18 months.
And do you have an opinion about now that the borders have largely opened, the employment rate in Australia in terms of domestic markets?
Yeah, look, I'm not qualified to comment on those sorts of things. I mean, there's much better economists than I am.
Sure.
As I said, what we can talk about is what we've seen in the trends in the past. Yeah.
Okay. So let's then move forward in terms of what the next 6 to 12 months may look like, not in terms of crystal balling, but just as it relates to the effect on commercial finance. So David, I might start with you. How do you see the next period playing out?
So the first thing is just from a consumer standpoint, I think that a lot of our customers have taken the savings over the last couple of years that they've been able to push away, and I think they've permanently reduced their total mortgage bill, and I think that's a trend that will stay. I think it's going to be something that people won't want to redraw back from their mortgages if they can help it. So I don't see massive consumer spending coming off the back of that side, which means that we probably won't see the inflation that everyone's predicting in the most dire of cases. And perhaps interest rates won't go as far as some of the people are actually suggesting. But on the other side of that, I think from a business standpoint, we definitely are going to see, and we're seeing it already, strong demand for cash flow type products, so business loans, trade finance. We're seeing that demand now. It's actually growing very, very fast within our platform. and I'm hearing the same from our peers. So this is probably in the SME side of things, in order to use that working capital and obtain working capital to buy goods from overseas, and even just obtain bulk purchases to warehouse that inventory. Just as we've seen those supply chain disruptions, people try and protect their business from not having that inventory, is what I think that we'll see over the course of the next 6 to 12 months.
Okay, Max, what about you?
Looking forward, my view is actually quite pessimistic around that. I think there are issues around the property market that the forecasts are quite dire, and that can affect the equity positions if businesses are relying on that for funding their operations and growth. So I think I'm quite sort of pessimistic on that, and I think that's going to roll through to consumer spending, and all the economic data I think is going to sour over the next 12 months to reflect a lot of that. So we'll sort of see where that sort of heads up. But one thing I'm really mindful of is also counterparty risk. It's not often sort of talked about, and Scott mentioned zombie businesses, but I think categorizing them as businesses that can't service existing debt or raise new capital, I think that categorization will increase. And so a business that is doing business with another business, there's counterparty risk there, and I think that's something to be really mindful of. So that's definitely something that is there.
Okay, and Scott, what about from your perspective?
Look, I think it's similar to what I said before. I mean, I think that if I look, I think the next 6 months is going to be really interesting. So I think, as I said, I'm probably not as pessimistic as others for a lot of the reasons that we've discussed, today. I mean, I think that, as I said before, there's money available, there's businesses looking to grow. All of the trends we're seeing are pretty solid. And just anecdotally talking to my customers, similar to Grow Finance, they're very similar story about good quality customers, and there is some risk. But I am, as I said earlier, I am cautious. So we are seeing insolvencies drift up to normal. One of the things we didn't talk about that I think is important is that we talk about insolvency levels, but what we don't talk about is voluntary exits. Mm-hmm. So, again, anecdotally, there were a lot of businesses who may not have gone insolvent but have shut their doors. You only have to go to some of the, sort of suburban, main streets to see that sort of impact. So, again, my thing I look at just personally, I think it's interesting to look at that sort of unemployment situation. So, I'm cautious, not overly pessimistic, but I think this next 6 to 9 months is going to be a really interesting time.
Indeed. And actually you raise an interesting point, because in contrast to the insolvencies, there was that massive boost of M&As. Have you, and David, maybe I'll put this question to you. So with the M&As that were occurring at the opportunistic business owners and so forth at the beginning of COVID, have you noticed that rate has continued at all?
It doesn't feel like it has continued to me. It's sort of like, I think that we will see that in the next 6 to 12 months, but really through that period, I think most businesses took a much more cautious approach. And I think that's actually stood them in good stead, because it means they've had the opportunity to optimise their cash flow and build that buffer that we keep talking about.
Okay. So Vlad, what about you?
Look, I'll probably remain on the fence, and I'm obviously very, very cautious about what's going to happen in 6 months' time. I think, look, I always enjoy talking to clients, SME owners, and I like to listen and to see what is it they see as an issue. And over the last 6 months, the consensus from most of them is quite similar. What worries them is the availability of labour and the cost of labour and the rising cost of labour. Cost of materials and stock, and availability of materials and stock, and that's across the various sectors of the economy. That tends to be two common concerns that people have. If through the means of migration and also the other ways, those two can be controlled, and the business owners are able to do what they need to do, is hire people and buy stock, I think we'll be okay. But I think we'll need to watch this pretty closely, and I'm pretty cautious. I don't think I'm very pessimistic, but I'm definitely cautious. I think what we will do is continue to watch different sectors and monitor their arrears and monitor what we're seeing through the pipe. And we will continue to make those adjustments and decisions probably on a monthly and quarterly basis. Definitely not going to jump at the shadows and start pulling out from certain industries or anything like that, but we will remain pretty vigilant. That's kind of, I think, where we are.
Okay. Well, I guess what we've done is dissected then what the landscape looks like, what the pressure points are, a bit of a crystal ball of what is on the agenda moving forward. But what I also wanted to do is really just pick the brains of the panel in terms of where the corresponding opportunities are. And obviously, you know, that age-old saying that disruption breeds opportunities. So, Max, I'm going to direct this to you. What should brokers consider in context of what's happening? How can they best be on the front foot to make sure that they're utilising this disruption opportunistically?
Staying close to customers and having good in-depth conversations is really important. Helping them plan for the next year, you know, stress testing that, three-way forecast, whether it's a growth scenario or a flat scenario or a down scenario, and helping businesses plan for that. And sometimes, you know, the best time to get capital equipment is actually before you need it. So, you know, so say last minute money is the most expensive kind of money. So if you can plan ahead, it's often much better to sort of do that now. So, you know, there's a lot of opportunities for brokers out there. There's more kind of lenders in the market. There's lots of different products and education that they can do around their clients and also for themselves. There's a lot of great courses out there for brokers on commercial lending. So I definitely sort of say, you know, whether it's a good market or a bad market, education is always a good investment.
So I guess to that piece, the upskilling is, I would expect, quite an important consideration in this time.
Yeah, absolutely. You know, learning how to have those conversations with clients, learning about new products, new markets, new opportunities, and commercial writing skills is definitely important. There's a range of courses online you can sort of find, so I definitely suggest that sort of brokers look those up and have a think about enrolling.
And are you noticing any change at all in terms of the referral relationships or the partnerships within industry, whether it's brokers with accountants, planners, valuers, lawyers, etc.? Do you think that the current environment has changed that notion of wealth community at all?
I'd like to think the broker, especially the commercial finance broker, is getting more of a role of a trusted advisor. You know, often SMEs would go to their accountant as sort of their go-to person, and you know maybe they're made at the pub or something. But you know, a proper commercial finance broker has a lot of skill and advice to impart to a business owner. And so within that sort of circle you mentioned, I think the role is kind of being elevated for the commercial finance broker, and I think that will continue to happen, particularly as they can provide really excellent advice.
And David, what about from your perspective? Where do you think the opportunities for brokers are at the moment?
Well, I think a large proportion of the rate rises have already been factored into account on forward prices, mainly through the 3-year swap market, so through the interest rate market. So I don't think that we're going to get massive changes there over the next sort of like 3 to 6 months. Pretty much the interest rate markets have already factored into account the rate hikes that we're going to see. So I think reasonably it's business as usual. We're not seeing any demand drop as a result of those high interest rates, and so it's not like anybody's going to be able to wait and get a better price. The rate rises are coming, and I think the opportunity there is just to go through the range of different products and actually find a bit like what Max was saying before. If there's opportunities for clients to actually obtain what they need today and get that in place today, when they do see that opportunity to get that order, to be able to take advantage of that order at that time, seems to be what I would be doing with my business.
Okay, and Vlad, from your perspective, are there any particular scenarios or industries that you've noticed really be a growth sector or in strong stead at the moment?
I think it's more of the same. What we're seeing is continued demand from transport and logistics. What we're also seeing is, which is a bit surprising, continued demand, actually increased demand in recent months from sort of fabrication, manufacturing sectors. So we've started to see a lot of transactions for fairly expensive pieces of equipment, which is quite unusual, which is basically around sort of fabrication, that sort of gear. I'm more sort of concerned about a couple of sectors, and one of them is obviously, it's no secret, is construction, and we're still lending in the sector, but we're just cautious and understanding that there's various sectors within construction. So we monitor that closely, which is probably understandable. We haven't seen anything at all that concerns us, at least on our portfolio. And I think also important to note, discretionary spending is probably something that we'd be very cautious over in the coming 6 to 12 months, and we've done an okay job in managing that internally as well. Look, at the end of the day, we're here to support businesses that are expanding and doing well. We're here we would typically lend on the cash flow of the business. If the business is trading well, regardless of what industry they're in, we're there to support them, and we'll do our best to sell as many products, or offer them, sell is probably not the right word, offer them as many products as possible to assist with that growth. So that's kind of the view we're taking. We would like to be there for every business in every different industry in Australia. Hopefully in 6 to 12 months things will improve, but we will be cautious, obviously.
And what about you, Max? Have you seen any sort of industries in particular or scenarios dominate your inquiries?
Not particularly as such, to be honest, but I think construction and building is definitely one that is on a lot of people's radar around that. You've seen some high-profile insolvencies and things, and that's a trend that unfortunately could continue. But none that sort of really concentrated. I think it's actually still pretty widespread. The onshoring of manufacturing is an interesting point you raised, Vlad. I think there will be more and more of that. As businesses look to sort of manufacture locally as opposed to importing where they can. So I think that's probably a really positive trend.
And Scott, do you have anything further to add?
No, I think the interesting thing is, if I look, we do a lot of trending by what's called ANZAC code or industry code, and the interesting thing that we've found is that the actual trend is pretty consistent across all of those. Mm-hmm. So, there've been, the ranking in terms of inquiries would have stayed pretty consistent over a period of time. And certainly when we index back to mid-COVID to now, if we look at our top 6 or 7 ANZAC codes, we've seen, all big increases in inquiry demand. So, and that's pretty consistent across all of them. So there's no, at least from that desire or that inquiry, there's no obvious trend that one of the industries was ranked number 1 is now ranked number 10. It's all been pretty consistent. So, which is basically what the guys have said.
Okay, fantastic. Well, I think the key takeouts that I've had from today is that perhaps even though the media's response is quite exaggerated, we are in a relatively cautiously stable environment, and it's definitely not panic stations. There are and are going to continue to be a lot of effects and influences on the commercial finance landscape, but I think we're now definitely in a place that's well and truly accepted. And therefore what opportunities a broker will have off the back of that. I find it interesting that there is uniformity of inquiry. There aren't necessarily industries or usages that are dominating. So I guess from a broker's perspective, it's just being aware, upskilling, having your eye on the ball, and making sure that you are collaborating with lenders, you're staying on top of research, you're looking at it objectively, and that you're really utilising this time to make the most of the commercial finance landscape. So thank you so much for our fantastic panel to come today. So Scott Mason, thank you. David, thank you. Max and Vlad, we hope we found today's panel interesting, and we look forward to seeing you next time.